Hello, and welcome to episode 8 of AltFinance, the Funding Frontier. I'm your host, Jason Feimster, and today we're delving into a vital topic that can reshape the future of any business: acquisition financing. This is a realm where ambition meets opportunity and where smart financing can turn aspirations into reality. Acquisition financing plays a crucial role in business growth. It's the fuel that powers the engine of expansion, enabling businesses to acquire other companies, assets, or essential resources. But it's not just about having the funds. It's about understanding how this type of financing works and how it differs from other financial instruments. Unlike conventional loans or venture capital, acquisition financing is specifically tailored to facilitate the purchase of another business or significant assets. It's a strategic move, a calculated leap towards growth and expansion, but it's not without its complexities and nuances. Today, we're going to break down everything you need to know about acquisition financing. We'll explore its different forms, dissect real-world case studies, and provide you with the knowledge to navigate this financial path successfully. Whether you're a seasoned entrepreneur or just starting, this episode will give you the insights to understand and leverage the power of acquisition financing. So let's dive in. In this segment, we're laying the foundation. Let's start by defining what we mean by acquisition financing. Simply put, it's a type of funding specifically designed for the purpose of acquiring another company, a business unit, or significant assets. The aim here is to grow your business either by expanding your capabilities, entering new markets, or increasing your assets. Now, there are several types of acquisition financing, each with its own characteristics and best use scenarios. First, we have bank loans. These are traditional loans provided by banks. They are often the first option many consider due to their relatively lower cost of capital. However, they come with stringent criteria and often require collateral. Next is mezzanine financing. This is a more flexible option, often used when a company can't secure enough bank loans or equity financing. It's a hybrid of debt and equity financing and usually comes with higher interest rates. Then, there's seller financing. Here, the seller of the business offers a loan to the buyer, which is repaid over time. This can be advantageous when traditional financing is hard to come by. And finally, leveraged buyouts or LBOs. This involves using a significant amount of borrowed money combined with a smaller amount of equity to acquire a company. It's a high risk, high reward strategy. Each of these options has its own set of advantages and challenges. Bank loans, while cost effective, require good credit history and collateral. Mezzanine financing offers more flexibility but a higher cost. Seller financing can ease the acquisition process but may involve slower growth. Leveraged buyouts can lead to high returns but also come with high risk. Understanding these nuances is crucial in choosing the right path for your business. As we move forward, keep these types in mind as we delve deeper into how they work in real life scenarios. Let's bring our discussion to life with some concrete examples of acquisition financing in action. These case studies will help us illustrate how different financing strategies can be effectively applied in real world scenarios. Our first case study revolves around a major tech company. Let's call it Tech Giant. In 2019, Tech Giant acquired a smaller but innovative AI firm, AI Innovations, to enhance its technological capabilities. The acquisition was valued at 1.5 billion. Dollars. Tech Giant used a combination of cash reserves and bank loans to finance this acquisition. This strategic move allowed Tech Giant to integrate AI Innovations' advanced AI technologies into its product lineup, significantly boosting its market position and innovation potential. The second case study is about a family owned small business, Be Well Health Foods. Be Well decided to expand its reach by acquiring a local health food chain in 2021, valued at 200 million. Dollars. Due to its size, Be Well opted for seller financing combined with some mezzanine financing. This approach enabled Bewell to manage the financial load effectively while expanding its market presence and product variety. These examples show a diverse applications of acquisition financing. Tech Giant's acquisition showcases the use of traditional bank loans combined with company reserves, typical in larger corporate settings. On the other hand, Bewell's story illustrates how smaller businesses can leverage seller and mezzanine financing to achieve growth. What's crucial to note here is the strategic reasoning behind these acquisitions. Tech Giant sought technological advancement, while Bewell aimed for market expansion. The financing methods were chosen accordingly, highlighting the importance of aligning your financing strategy with your business goals. Understanding how to secure acquisition financing is as crucial as knowing the different types available. This segment will walk you through the essential steps and what lenders typically look for when evaluating an acquisition financing application. First, preparation is key. You need to have a clear acquisition plan that outlines your target company, the rationale behind the acquisition, and how it aligns with your business strategy. This plan should include a detailed financial analysis, projecting how the acquisition will impact your business financially in the short and long term. Lenders will scrutinize your plan. They'll look at the financial health of both your company and the target company. Key factors include revenue, profitability, cash flow, and debt levels. They'll also evaluate the synergies expected from the acquisition, how well the two businesses complement each other. Your creditworthiness plays a significant role too. Lenders will access your credit history, existing debts, and repayment capabilities. They're looking for assurance that you can manage the additional debt. Negotiation skills are essential during this process. It's not about just getting the financing, it's about securing terms that are favorable and manageable for your business. This might involve negotiating interest rates, repayment schedules, and covenants, or conditions that lenders put on loans. One tip for successful application is to demonstrate a thorough understanding of the industry and market trends. This reassures lenders that you're making a well informed decision. Also, be prepared for due diligence. Lenders will conduct a comprehensive review of all the involved parties' financials, legal standings, and operational efficiencies. This process can be rigorous, so having your documents and data well organized can expedite the process. In summary, securing acquisition financing requires a well crafted plan, a strong understanding of your financial standing, negotiation skills, and a readiness for thorough due diligence. Approaching this process with diligence and preparation can significantly increase your chances of securing the necessary funding. Now that we've covered how to secure acquisition financing, let's talk about using it effectively. Acquisition financing is a powerful tool, but like all tools, it needs to be used wisely to maximize its benefits. Firstly, strategic planning is paramount. Before even seeking financing, you should have a clear strategy for the acquisition. This means understanding not just why you're acquiring a company, but also how it fits into your long term business objectives. Are you looking to enter new markets, acquire new technologies, or eliminate competition? Your strategy should dictate how you utilize the financing. Once the acquisition is complete, financial management becomes crucial. Integrating another business into your own can be complex, and missteps can be costly. It's important to have a detailed integration plan that covers everything from aligning business cultures to consolidating financial systems. This plan should aim to realize the synergies and efficiencies you projected in your acquisition plan. Risk management is another key consideration. Acquisitions, especially those financed with debt, can add significant risk to your business. It's important to have a clear plan for managing this risk, which might include contingency plans for unexpected integration challenges or market changes. Communication is also critical, both internally and externally. Your employees, stakeholders, and customers need to understand how the acquisition will benefit the company and what changes they can expect. Clear, consistent communication can help increase and ease the transition and maintain morale and brand loyalty. Finally, don't underestimate the importance of ongoing monitoring and adjustment. The business world is dynamic, and even the best laid plans may need to be tweaked. Regularly review your acquisition's performance against your initial objectives, and be prepared to adjust your strategy as needed. In essence, the effective use of acquisition financing is not just about the financial transaction, it's about thoughtful planning, careful integration, risk management, clear communication, and adaptability. These elements are crucial for turning the financial opportunity of acquisition into long term business success. As we navigate through the complexities of acquisition financing, it's important to stay ahead of the curve by understanding the emerging trends in this space. The landscape of acquisition financing is continually evolving, influenced by economic changes, technological advancements, and innovative financing models. One significant trend is the increasing role of technology in the acquisition process. Fintech companies are revolutionizing how business access financing, offering more streamlined and accessible funding solutions. This includes automated underwriting processes, which can speed up the approval process, and blockchain technologies, which add transparency and security to financial transactions. Another trend is the growing importance of ESG, environmental, social, and governance factors in financing decisions. Investors and lenders are increasingly considering a company's ESG performance when evaluating financing requests. Businesses that demonstrate strong ESG practices are often viewed as lower risk investments, which can be advantageous when seeking acquisition financing. We're also seeing a shift towards more flexible and creative financing structures. This includes the use of earnouts, where part of the purchase price is deferred and contingent on the acquired company's future performance. Such structures can align the interest of the buyer and seller and facilitate smoother transactions. In response to the economic fluctuations, such as those brought on by the global pandemic, lenders are also becoming more cautious. This has led to tighter lending criteria and an increased emphasis on due diligence. Businesses seeking acquisition financing need to be prepared for more rigorous scrutiny and may need to provide stronger evidence of the acquisition's potential value. Lastly, cross border acquisitions are becoming more common, thanks in part to globalization and the digital economy. This brings new opportunities but also adds complexity as businesses must navigate different regulatory environments and cultural differences. Staying attuned to these trends is crucial for anyone looking to leverage acquisition financing. By understanding and adapting to these evolving dynamics, you can position your business to take full advantage of the opportunities that acquisition financing offers. We've covered a lot of ground today on acquisition financing. Now it's time to hear from you, our listeners. We've received some great questions, and I'll do my best to provide insightful answers. First question: how do you determine if an acquisition is the right strategic move for your business? Great question. Determining if an acquisition is right for your business involves several considerations. First, assess how well the acquisition aligns with your long term business goals. Does it help you enter new markets, acquire key technologies, or eliminate competition? Also, evaluate the financial impact. Will the acquisition be an increase to earnings? What are the risks involved? It's about balancing strategic fit with financial prudence. Next question: what are the biggest risks in acquisition financing and how can they be mitigated? The biggest risks include over leveraging, where the debt incurred to finance the acquisition becomes unsustainable, and integration challenges, where the merged entities struggle to operate efficiently together. Mitigation strategies include thorough due diligence before the acquisition, ensuring the debt level is manageable, and having a solid integration plan post acquisition. Last question: Can small businesses effectively utilize acquisition financing, or is it more suited for larger corporations? Absolutely. Small businesses can and do successfully use acquisition financing. The key is choosing the right financing type that matches the size and capacity of the business. For smaller businesses, options like seller financing or smaller scale bank loans can be more appropriate. The principles of strategic alignment and careful planning apply irrespective of the size of business. Thank you to everyone who sent in questions. Your engagement makes this podcast a rich and interactive experience. As we wrap up today's episode on buying power, acquisition financing made simple, let's quickly recap the key points we've covered. We began by understanding the essence of acquisition financing and how it differs from other forms of financing. We explored the various types of acquisition financing, including bank loans, mezzanine financing, seller financing, and leveraged buyouts, each with its own set of advantages and challenges. Through real world case studies, we saw how different businesses successfully navigated acquisition financing to achieve growth and expansion. We delved into the process of securing acquisition financing, emphasizing preparation, negotiation, and due diligence. Effective use of acquisition financing was discussed, highlighting the importance of strategic planning, financial management, and risk mitigation. We explored emerging trends in acquisition financing, keeping an eye on technological advancements and changing economic landscapes. And we gained valuable insights from our guests on best practices and common challenges in acquisition financing. I hope this podcast has provided you with a deeper understanding of acquisition financing and its critical role in the business growth. Remember, whether you're a small business owner or the CEO of a large corporation, acquisition financing can be a powerful tool in your growth strategy, provided it's used wisely and strategically. Thank you for joining me on this journey through the world of alternative financing. Don't forget to subscribe to our podcast for more insights into the dynamic world of finance. This is Jason Feimster, signing off from AltFinance, the funding frontier. Stay ambitious, stay informed, and keep pushing the boundaries of your financial potential. Until next time.